A very good afternoon to all my dearest student friends. Indeed, it gives me a great deal of pleasure in welcoming all of you to this session. And I sincerely hope that all are fine at your respective end. Today, I am going to discuss something about banking and other allied regulations. Here, I'll be talking about the introduction of banking and other allied regulations and how the evolution of banking regulation was made and what are the regulations in relation to chartering, what are the regulations in relation to licensing, what are the different regulations in relation to the banking management. Apart from that, I will touch upon the regulations with respect to ensuring liquidity. In addition to that, I also discuss about the regulations with respect to the healthy lending practices and the reporting requirements, the inspections, how it is done, and what is the necessity of audit. And at last, I must also discuss about the penal powers. So it is expected after hearing the deliberation, students will be able to understand the evolution of banking regulation. After hearing the deliberation, a student will be able to explain the terms and conditions to be complied with for obtaining a bank license. After hearing the session, a student will be able to discuss the interface of Banking Regulation Act with other laws, and a student will be able to describe the role of central government in regulating the banking sector in India. So to start with the introduction, I must say the regulation, and that too the regulation of financial sector, is extremely important. But within the sector, banking sector organization is most important. The reason has to do with the importance of the role that the banking sector plays in the economy. And as we know, the fragile nature of the business model of the banks and the consequences of bank active failures, as has been observed in most of the serious recessionary phases in the recent history, including you may talk of the Great Recession of 2008. So banks not only serve as a depository of people's savings, but also banks serve as a payment mechanism. And when I'm talking of payment mechanism, I refer to the payment system. And the payment system, which majorly runs on payment, payment orders made to, and you have checks which are drawn by us on our banks and runs on the assumption that the amount standing to our credit in the account is as good as your real money. So you have an agreement. Already we have discussed about the agreement. Here the agreement between two parties. Agreement between two parties to do an impossible act itself is void. The contract may also void because of an event. And the event which makes the performance of the promise impossible. Performance of the promise unlawful after the completion of the contract. So the amount shown in our account as credit is mere debt due to us from the bank, and which is repayable on our demand. So we have confidence, and our confidence that it would be so paid whenever asked for. And the ability of the bank in almost all instances to do so ensures that we always treat it as good as money. But we tend to forget that the bank lends this money, and to cover for its cost, obviously what we normally look for the operation and the interest paid to us, and it has to lend it at a higher interest rate, which would usually be for a fixed duration. So within that, there will be no change. But when it is a floating, so it will get changed. But the fact remains, when you come to a situation where the bank has liabilities, and the liabilities which are short-term in nature, and the assets which are long-term. So you may say, sir, this is a mismatch. But this mismatch between the time frame of assets and liabilities is what underlies the fragility of the banking business. So the business we are talking of not only has to manage the liquidity, but also the business has to ensure that the depositors retain confidence, customers retain confidence in the bank, so that not only the fresh funds keep coming into the bank, and that will match the payment orders, that will match the instructions, but also that the depositors don't lose confidence in the bank, as the loss of confidence would certainly would cause a run on the bank, causing it to fail. So a bank failure has an effect on all segments of the economy. The depositors not only lose their liquid assets, but may even be the cause of failures of businesses which use the failed bank for receiving and making payments. and thereby for providing bank guarantee, because bank guarantee on which had an overdraft facility on the bank of the security given by them. So this would now not be released anytime soon till the bank insolvency process is completed. So this may even have a systematic effect if the entity is large, because a bank failure may lead to a panic reaction normally among the general mass of depositors, leading them to withdraw deposits from other banks. Apart from that, causing a bank wrong. So healthy banks would fail if suddenly there's a run on their deposits. So here the depositors and the businesses dependent upon them fail, and soon enough an isolated instance of bank failure balloons into a system-wide series of failures, as was experienced during the Great Depression of 1929 and Great Depression of 2008. So the failures also affect the money supply floating in the economy, as the banking system, which we are talking of, multiplies the money. So the money in circulation due to the operation of banking system is usually a few multiple of the base money, as normally printed money, or you may talk of issued coins. Now coming to the evolution part of banking regulation, after understanding the importance of banks in the economy, after understanding the necessity of regulating them more than other players in the economy, one question arises as to who is best placed to regulate the banks and the legal basis of the regulatory power. Obviously, the first necessity for bank regulation came by the need for cooperation. It is the cooperation among the banks in executing payment instructions and making collections on the checks deposited with them. So instead of changing each bank individually, it was thought fit to have a central place where the banks of a local area could meet, and instead of paying each check individually to another bank for the other bank's customers, only the net balance due to each bank be paid, so that the local areas had a clearing houses, and since you have checks honored in the interim may bounce, either this bounce will happen either due to insufficiency of funds, or sometimes signature of the purported check writer which is not matching, and the collecting bank had to be solvent enough for return of money in such cases. And the clearing house, when I'm talking of the clearing house, it is the clearing house membership was an informal regulation of the industry as it was dependent upon the confidence in the solvency of the banks normally who meet. But the role of industry specific bodies in forming standards for the guidance of its members has over a period of time, I must say, has become more formal, and it is all recognized by courts in determination of the industry standards for service. So here it would be appropriate to mention one thing, that the fragility of the banking system meant that whenever there was a run on the banks, howsoever it is well run and solvent, they might be individually. Howsoever, one thing that is to be seen, that good their assets quality be, there could always be a chance that they might fail. So in this case, no other financier would be willing to lend to the bank because it would be afraid that even if the money lent is not lost, but it might so happen that it may not be available to it in times of crisis. So a necessity was felt, so a need was felt for the lender of last resort, and that too in times of crisis. So an entity willing to lend when no one is willing to do so because there are dependent on demand deposits to lend. So entities should not depend on retail deposits and have the power to create the money which is accepted in a valid tender. So if I look at the late 19th century, it is reminded that the Bank of England emerged as a lender of last resort to the English banks. In the first decade of the 20th century, the Federal Reserve Board was formed to be the lender of the last resort in the United States of America. And during the Great Depression, the necessity was felt, need was felt to have a lender of last resort. So in pursuance of this strongly felt need, the Reserve Bank of India was formed way back in 1934. So basically, the structure followed that the banks which we are more concerned about, which wanted to be eligible to be considered for lending by Reserve Bank of India, has to maintain a certain percentage of their deposits, which the lender of last resort, that is the central bank, and had to observe some kind of prudent business practices which are to be considered for the purpose of lending, and that too in emergency situations. So it is like a bank exercising some kind of control. It is like a bank exercising some kind of surveillance over a borrower who has been given an overdraft facility. So with banks having deposits with the RBI, it is also the role in the clearing house operations. And that is how we normally give it a bird's eye view of the working of the financial system and the solvency of the individual players. So we have regulations, and if we look at regulations by perception, and that too perception of solvency, we have contract, they were thought to be insufficient. Now we look for regulatory power. A regulatory power was not statutory, as though the entities like Bank of England or Reserve Bank of India may have come into existence either by charter or by statute. The shareholders were private individuals, and after the nationalization of Bank of England and the Reserve Bank of India, regulatory powers were given to the central bank in the same way as they could be exercised by the state executives wing of the government. The powers have been reserved with the executive wing of the government in some countries, but it was very much thought appropriate to give it to an entity which has expertise in the sector, which would anyway perform a regulatory role with regard to most of the banks, because of it being the lender of the last resort and thereby avoiding duplication of effort. So in this way, the regulatory power over the most of the banks one can have. The government retained for itself the role of giving directions where it found appropriate and being a forum for the purpose of appealing for most decisions taken by Reserve Bank of India. So while Reserve Bank of India has the primary role in regulation of banks, it shares the regulatory space with certain other bodies. So in case of agricultural cooperative banks and regional rural banks, National Bank for Agriculture and Rural Development, NABARD in short we call it, also has a regulatory role as it is the principal refinancing body for these banks serving specific needs of the sector of the economy. Similarly, in the case of urban cooperative bank, the principal means by which Reserve Bank of India used to regulate was by being the lender of the last resort for the bank, and which were in the second schedule of the Reserve Bank of India Act. And recently, by making amendment to the Banking Regulation Act, your Reserve Bank of India has been given a primary regulatory role over these banks, almost at par with what it has in the case of commercial banks. However, it ought to be noted that your cooperatives, having been organized under the state statutes, and that this is relating to cooperatives. So we have register of cooperatives of the state of incorporation. We'll also have a regulatory role, not so in case of multi-state cooperatives. So in case of public sector banks, the regulatory role of Reserve Bank of India is dependent upon how much of the regulatory powers that too relating to them is ceded by your central government to the Reserve Bank of India under the Banking Regulation Act, because at present central government has given the RBI almost all the powers over the public sector banks, which RBI has over the private commercial banks, with the exception of the powers over the board and other officials of the bank. So we have considered regulation by industry standard, setting bodies, going for contractual arrangements for deriving of benefits either as lender of last resort or financing arrangements, or you can say deposit insurance or by statute. Another source of regulation is the soft law. Soft law framed by different international associations for the purpose of regulations, for the purpose of regulators, for the guidance of the member regulatory bodies. But it would be appropriate to mention one thing, that the first is Bank of International Settlements, your Basel, and the Financial Year Task Force. So we have banks for international settlements, which was originally a very small body of central governments of developed economies. But over a period of time, its membership has recently expanded. The bank has, at its primary remit, the stability. Stability of the international financial system, because after the Hostrat crisis way back in the mid 70s, there was a failure. With the failure of the German bank created problems for the payment system in Europe. So, Bank of International Settlement has sought to address the issues of how to ensure the banks which are participants in the international payment system and what are its mechanism to carry forward, or you just stay solvent to honor their behavior. And towards this end, with the sanction of the member central bank, it has periodically made rules for calculation of the capital required by the bank for doing the business. Though we know that the rules are made only for the bank engaged in for the purpose of cross-border payments, which belong to the member states' requirements of your international trade and international payment system. Operation almost made it incumbent to most of the central banks to frame regulations based on your Bank of International Standards. So here, one has to remember one thing, that the regulatory bodies, they also acquire expertise to certain sectors of the economy. The legislature may even want to use expertise, and those expertise developed by these bodies for regulating the allied sectors. Sometimes what we have observed that this is very, very necessary as carrying out the responsibility of one area, which may cause, which may require some kind of input from the corresponding action in another arena. And in this case, One has to remember the regulatory bodies acquire expertise in certain sector of the economy. The legislature may want to use the expertise developed by these bodies for the purpose of regulating the allied sectors. Sometimes it is easy to carry out the responsibilities of one area may require an input from the corresponding action in another area. So in the process, there is regulation in relation to chartering, there is regulation in relation to licensing. When we talk about bank, every family has some kind of bank account. Every family has some kind of business transactions through bank. Bank is a business of borrowing and lending money, but with special features. What is absent in other borrowings, in other lending businesses, not only are the deposits with it repayable on demand, but they are repayable only in the branch with which the account is kept. And the bank also gives the check facility to its customer. And bank would collect check on their behalf. So the last requirement means that the bank has to take a debt or deposit from the customer. Whether the customer wants it, the bank cannot refuse it as in case of ordinary debtors. So Banking Regulation Act prevents any person to give a check, providing writing facility to its customers. If the person or if the entity is not a bank. And further, it prevents the use of the term bank by any entity, which is not a banking company registered under the Banking Regulation Act. So with the bank, well, banks were in business long before, but there is a time frame which was given for such banks to get their license. Then only you can operate. Need a license from Reserve Bank of India. So the grant of license is the discretion of the RBI. And the grant or license, even if it is a discretion, then the other thing, the BRA lays down certain conditions for the exercise of its discretion. Conditions when it is required to be satisfied before grant of a license. And here, the company must not only be in a position to repay present and the future depositors, they are in full as their claims accrue over a period of time, but they should have adequate capital structure, they should have adequate learning, you can say prospects, along with the charter of the proposed management. In addition to that, the conduct of its affairs, not being opposed to public policy or opposed to interest of depositors, Because in addition, the Reserve Bank of India will look into the public interest, or the Reserve Bank of India will look for the interest of depositors upon their safe. So in addition to the Reserve Bank of India will look into the public interest. Not only public interest but also the availability of banking facilities in the proposed area of operations. So while granting the license, the Reserve Bank of India may lay down the conditions to be fulfilled by the licensee, like contractor, contractee, offerer, offeree. Similarly, when we talk about granting license, Reserve Bank of India may have lay down, he may lay down conditions to be fulfilled by the license when operating as a bank. So now talking about the RBI, Reserve Bank of India, or talking about the Banking Regulation Act, gives Reserve Bank of India with amplitude in the granting of a license. The RBI has in the recent times given out a policy paper, not on how it should exercise its discretion. So the conditions for the license for different types of the bank, they are different of each of them, and they would always pose different risks to the financial system. You may talk of parents, you may talk of banking and regulation, law license for commercial banks, which are in three categories, no permit is required. So the first thing is to see that how best they are in a process of negotiating. RBI license is also required for operating a bank branches. And if you look at the definition, company is interested to sell, your purchases to provide delivery. So here, RBI license is also required, and we always try to take into account all payments. And at present, such licenses are not individually given for banking companies, have been given the general impression to open branches and to provide some kind of special distribution in terms of rural and urban branches. That is being maintained. So foreign exchange wanting to open branches, and it gained on the basis of reciprocity. Indian Bank can open branches in the country of incorporation of the foreign bank. So the latest guidelines of the RBI provide that the foreign banks wanting to start a bank in India, and that will serve to do so through a subsidiary. You can talk about incorporated in India, as it would always try to insulate the Indian limb of the business of the foreign bank. From the fluctuations normally we come across in the fortunes of the foreign bank in other jurisdictions. So for any bank to be licensed to operate as a bank, essential aspect required to be looked into the chapter 1. So capital of the banking company will have two aspects: initial capital and you have capital in relation to business. So the capital can be in the form of equity shares and irredeemable preference shares and debt in form of debentures, the both, that is convertible and non-convertible. Or even you can take the help of bonds, promissory note, which are very much subordinate to debt, maybe due to the depositors. So the capital requirement which we are looking for, which are subordinate to debt, maybe in the form of equity shares or bond, which are the subordinate to debt due to the depositors. And you have capital requirements which can further be divided into tier 1, tier 2, depending upon the how premature in capital. And in the process, the capital requirement can be further divided into tier 1 and tier 2, depending upon new permanent, depending upon how the permanent the capital is. So tier 1 companies, equity shares, irredeemable preference shares, and some debentures or even bonds with the condition that their redemption is dependent upon the banking company and thereby fulfilling extreme conditions as it wanting to redeem it. Now coming to the regulation, when we are talking of regulation in relation to the bank management. As was observed earlier, and the law is concerned very much about the general character of the proposed management as to how the affairs of the bank, they're all conducted, and so that the public interest and the interest of the depositors, the customers, are never affected. They are not affected at all. So there are two aspects. One is who controls the bank, that is the shareholders' composition. And the second one, the degree of control a body of shareholders who can exercise. And the second issue comprises the quality of the management and its conduct. So it is important for the banking companies depositors as to the distribution of the shareholding and what is the extent to which the control that the dominant group of shareholders they exercise over the bank. And part of the problem is always taken care of by BRA, and the part of the problem is taken care of by the conditionalities laid down by the Reserve Bank of India in giving license and its power to issue direction to the bank. First of all these statutes denies voting rights to the preference shareholders That is irrespective of the fact that they have not been paid preferential dividend for the 2 years or more. Secondly, even in the case of equity shares, no shareholders can exercise voting rights in excess of 10% of the issued equity to the bank. So the cap on the voting powers can be increased by the Reserve Bank of India, can go up to 26%. The thirdly, no one on his own or in concert with others can own 5% even or more of the equity share capital or voting right in a company without the prior permission of the Reserve Bank of India. So in addition to these statutory restrictions, I must say Reserve Bank of India at the time of granting the license, even it lays down a schedule for the dilution of the promoter of the banking company, and these are to ensure that the individual interest do not get equivocated with the interest of the bank. And you will notice that there is a delivery, and this is a case we always look for, that these are to ensure that the individual interest, they don't get equivocated with the interest of the bank, and there is always a diversity of shareholdings and voting power so that there is sufficient control over the dominant shareholders without there being a takeover which may not be in the interest of the depositors. And another thing, this BRA deals with the potential conflict of interest between the bank and its board. A banking company is always forbidden to lend to any director or to any person in whom the director may be interested in. Further, a bank may not remit any debt due from a director or any other person in whom the director may be interested in without the prior permission of the Reserve Bank of India. So this blanket ban on power to remit extends to extension of the time for repayment or the change in the terms of payment, either the case. So after dealing with the conflict of interest, it must deal with the composition of the board, because what we have seen, majority of the board needs to have technical expertise which are very much required, and in the public interest, and that too interest of the depositors, customers, for securing proper management of the banking company, Reserve Bank of India (RBI) can remove any managerial personnel, starting from the chairman, managing director, chief executive officer, etc., or the officers or the employee from the office after following due procedure, of course, and appoint its own nominee to the post. And for the same reason, it may also appoint additional directors on the board of the banking company and also in consultation with the central government, supersede the board of directors and appoint an administrator to manage the affairs of the banking company. So that is why it would be worthwhile to note one thing that many of these provisions with regard to managerial personnel with suitable modifications are also applicable to cooperative banks. And in case of the public sector banks, and when I say public sector banks which are very much governed by the separate statute by which they were all formed, by which all were nationalized. So the powers are exercised by the central government. So regarding the regulation with respect to ensuring liquidity, with respect to ensuring healthy lending practices, as we have discussed till now, the banking business is inherently fragile as it lends for long-term purposes from on the basis of funds which are borrowed from short-term sources. So other than ensuring that the management should not be such that it may compromise the interest of the depositors, certain norms have to be in place so that the liquidity is maintained and the bank's business is run in such a manner that it remains solvent always. So these statutory provisions came about in the background of your historical experience from some famous bank failures, which the legislature did not want to be repeated. So that certain no-go areas for the bank, which Parliament has itself prohibited. And apart from that, also it has allowed some kind of relaxation. First of all, when we are talking of bank and in addition to banking business, can only do business that is permitted by section 6.1 of the banking regulation and other allied though the last subclause of section 6.1 allows that the government to notify any other business, government to notify any other activity even which a bank could engage in. So what it cannot do directly, it cannot do indirectly as well. So no bank could have shares in excess of 30% of the shares in any entity not engaged in a business mentioned in section 6.1 Banking Regulation Act. So this restraint on shareholding is with reference to holding in any form whatsoever, that is as an absolute owner, mortgagee or pledge. In addition to the constraints imposed expressly by it, Banking Regulation Act gives rules making powers to the Reserve Bank of India. Though Banking Regulation Act uses certain term guidelines, uses certain directions for such rules made by the Reserve Bank of India, they are binding on the bank. Though the lending decisions may be in contravention of them, may still be enforceable in a court of law. But I must tell you one thing, that Banking Regulation Act, BRA, recognizes that such guidelines may be specific to a bank or maybe general, applicable to all banks, all classes of banks. So RBI, when granting a license, may grant it subject to certain conditions, including conditions relating to loans, which a bank can give as it does in case of small finance banks and payment banks. So for otherwise, your Reserve Bank of India, that too in public interest, or you may say in the interest of the banking policy, or in the interest of the depositors, or in the interest of having proper management of the banking company, it may give general directions or specific direction to bank. It is in pursuance of this power, the Reserve Bank of India, in fact, has implemented the Basel Accord norms in India and giving banks some kind of guidelines as to income recognition, a frequent cause of bank failure by suppressing its weaknesses, the NPA non-performing asset recognition, its classification, your debt restructuring of enterprises, and hauling the insolvent enterprises to NCLT for insolvency proceedings. So to handle potential liquidity crisis in a bank, even if it is well run, we look for the law. Law follows two prolonged approach. The first is to prevent some kind of sudden abnormal surge in the need for liquidity, which may be due to your panic amongst bank customers. And the second approach is to ensure that the bank has enough investments in assets which can be considered liquid, so that the cash could be rustled off whenever there is necessity need for it arises. So to prevent panic, the Banking Regulation Act makes it a punishable offense. Punishable offense, any act which is designed to undermine the confidence of the depositors in a banking company. So apart from that, also the reporting requirements, the inspection, the audit, which are also very much important. So it is important for the regulator to be aware of the health of the regulated entities. And when I say so, this is not just to see whether compliances that is in accordance with the letter and the spirit of the regulation, but also to allow a preemptive action which is to be taken to ensure that the regulated entity doesn't fail or its failures will happen. If inevitable, doesn't pose a systemic risk. So because we have got three pillars of the regulatory awareness. They are regular reporting, they are your statutory audits by trusted auditors. Apart from the third pillar is the inspection. So in case of banks, these three, they serve as an additional avenue of information in addition to what is gleaned by Reserve Bank of India from the working of the payment system. So obviously, we always look for all these three, which are very much important. So that is why we have penal powers. Any regulator power have three components. One is legislative, that is rule making, executive, and judicial. And when I say judicial, power to impose penal sanctions. So the third component is an important as the first two components because it is the third component along with the expertise in the subject matter which puts the fear of the regulator in the hearts of the regulated. What can be penal consequences for non-observance of the regulatory guidelines, the directions other than that of your change of key personnel, suppression of board, your nomination of additional members on the board, which the Reserve Bank of India can exercise or can threaten to exercise the ensure for the purpose of ensuring compliance. So, so the regulations of the financial institutions is extremely important because of its unique nature of financial asset. So it is an asset which derives its value and by descriptions, and for which Banking Regulation Act is very much required, and therefore the provision for evidence by banks in Bankers Book of Evidence Act, the nomination in the Banking Regulation Act, and sharing of your credit information under the RBI Act and Credit Information Companies Regulation Act, they always seek to remove the landmines which are there in law in the conduct of banking businesses. Thank you very much. We come to an end of this deliberation. Thank you very much. Have a nice time. Good day.